Hello everyone, welcome back. Hope your day is good. Hope everything is going fine for you. Been a bit of a tumultuous week this week in the stock market, but it ended on a very high note. Thank goodness. Hopefully all of you have been working hard to get your investments in order and diversified. You're working on your 401ks or 403bs or 401as or your IRAs or your Roth IRAs. Hopefully you're putting all that together and doing what you need to do to ensure you're building generational wealth for your future as well as for the future of your families. And I just want to talk to you a little bit about that because I think it's important that, you understand that in every stock market, in every bull market or bear market, there are going to be cycles, right? There are going to be days when the bull market is looking really good. Things are up 1%. Those are amazing days. And then there are going to be days when things are not looking so good. And maybe they're down 1%. And you have to take those days, the good with the bad. And that's just the way it is. So, in a week like this, there's a lot of fear, a lot of emotionality, a lot of people giving you advice, telling you what you need to do. But here's my advice to you. Develop a plan, okay? Your plan may be, look, I'm going to put away this amount of money every week. I'm going to live on 50% of my money. I'm going to invest 20% of my money. Or something like that. I'm going to live off of 70% of my money, and I'm going to, invest 15% of my money, and then do this with another 25% of my money, save it, make sure I have a rainy day fund in order, etc. But the point really is that you're going to stick to your guns. The money that you're putting on the side to invest, you're going to invest that in your diversified stock portfolio. Maybe you're going to include some bonds, like a total bond fund. Maybe you're going to add to that by having some money in gold. Maybe you're going to look at some sector investments. Some technology or petroleum or energy, things like that, commerce, banking. Or maybe you're just going to stay very diversified and you're going to go with the S&P 500 and that's going to be it. You're going to have your S&P 500 fund and you're going to, or maybe you're going to have your total stock market fund. And you're going to have a little bit of an international fund, international stock fund. And that's what you're going to do. The point is you're in it for the long run. You're not a trader. You're not trying to time the market. You're not saying the market's going to go up, so I'm going to buy. And the market's going to go down, so I'm going to sell. And then I'm going to turn a profit here. And then I'm going to do that. No, that's not investing. That's trading. That is almost tantamount to gambling. Same idea with Bitcoin. I think Bitcoin is speculation. I'm not alone in that regard. Warren Buffett thinks Bitcoin is speculation because he doesn't understand it. And the secret is, if you don't understand something, you ought not be investing in it or putting your money into it. I don't think Bitcoin is really an investment. Bitcoin is speculation. I'm talking about all of these, types of alternative currencies that people like to invest into. It's really, you need to understand what it is you're investing in and then go with it. S&P 500 fund, you could understand that. It's diversified. You're going to invest in the biggest 508 companies in the United States of America. And you're going to put your money into those shares and you're going to stick with it. And hopefully good times. And then when the bad times come, you're going to take your 8-10% hit and then you're going to stick with it. You're not going to sell any shares. And guess what? It's going to grow back past that 10% that you lost. And pretty soon you'll be up 10%. So some years you'll be down 5%. Some years you'll be up 15%. Some years you'll be down 8%. Some years you'll be up 20%. So I think the important thing is that you're in it for the long haul and that you are investing using low cost mutual funds or exchange traded funds that are giving you a widely diversified portfolio. So you're buying many companies, not throwing all your money into Nvidia and then wondering why, Nvidia went down a dollar a share and now you're in a panic. You want to be diversified. Total stock market fund, S&P 500 index fund, total bond market fund, some variety of those things. So perhaps you want to have 80% in your S&P 500 index, and maybe you want to have 20% in your total bond market fund, where you can make dividends every month, and that puts money into your portfolio. You could buy more shares or let that money grow in a money market, etc., etc. The other thing I want to talk to you about is what you're going to do with the money that you're saving to make sure you have an emergency fund, and how you want to keep that money growing as well. So what you want to do is look for a high yield savings account. And these are usually from banks. Although if you look on your Fidelity account, you'll find some high yield sweep accounts that are growing at over 5% right now. And that's where you want to keep your emergency money. So that 3 months of emergency money for your 3 months worth of bills that you're saving and you're keep that growing at 5% if you can right now, while the interest rates stay up. Capital One has a high yield savings account. I think it's at 4.25% right now. What you don't want to do is take a lot of money and keep it in your checking account. Your checking account really should have 1 month's reserve of bills, and then you put your earnings in that every month, and then you move that money into your high yield savings account, you move that money into your portfolio, you move that money into your Roth IRA, and you make that money work for you. That's the magic of passive income. That's what you need to be doing. Every day, your money needs to be doing something for you. Sitting in a checking account, it's making 0% interest. It's not doing anything. It's sitting there. You put $1,000 in there, it'll be $1,000 in 10 years from now. You put $1,000 in the S&P 500 index fund, and it'll grow at about 10% a year. Compounding. Remember, compounding interest. Remember, passive income. If you don't understand what these things are, go on Investopedia and look them up. Read about them. Learn. Become a better investor. Don't listen to some random guy on YouTube, right? Don't listen to family and friends, although sometimes those are reliable, helpful sources. but may not really always know exactly what they're talking about, right? So go on Investopedia, go read Yahoo Finance, listen to talks that Warren Buffett and Charlie Munger have given talking about this. Listen to Ray Dalio. Listen to some of the great investors of our time. And you know who they are. You can look them up. Google great investors of our time and see the list that comes up. They've all written books. They've all had books written about them. So you should really be working hard to sharpen your sword in investing and learning exactly what all this is all about, and then putting your plan together and executing your plan. And when times are tough, you don't sell your shares in the S&P 500 or the total stock market or the total bond market. You don't do that. When times are good, you don't do that. The point is to put that money there and let it grow over time. That's how you're building generational wealth. Never stop learning. Don't stop believing. And hopefully I'll see you soon as we take another little walk in the park. Thank you guys. Have a great one. Like and subscribe. See you soon.